It is happening. Gold and silver are pumping right now. Silver just blasted through $94 an ounce. Gold just crossed 5,250. Both of them ripping at the same time. If you have been I break down the three massive catalysts that hit today, look at this. This morning at Bullion Star, one of the largest physical precious metals dealers in the world, there were massive queues outside the store, real people standing in line, waiting to buy physical gold and physical silver, not clicking buttons on Robinhood, not buying paper ETFs, standing in a physical line to hold metal in their hands. I'm showing you the footage right now. Look at this line. When people are queuing up to buy silver at $94 an ounce, that tells you more than any chart ever could. This is fear. This is real demand. Something has fundamentally shifted. And after what I'm about to show you, you will understand exactly why these people are standing in that line. Hey, James here. This is Noble Metals. If you're new here, this is where I break down the data that Wall Street does not want on your radar. Press the subscribe button right now so you do not miss what is coming next. Takes 1 second. It costs you nothing, but it tells the algorithm to push this video to more people who need to see it. Help me get it out there. Write a deeply analytical section examining the significance of silver printing 10 consecutive green monthly candles as of February 2026. Explain in detail why such a streak is historically rare in modern silver trading history and why it almost never occurs in metals that are topping out or entering speculative blow-off phases. Discuss historical precedents where prolonged monthly green streaks signaled structural shifts in market participation rather than short-term momentum trading. Emphasize how consistent monthly closes above open reflect steady institutional accumulation rather than emotional retail speculation. Break down how each dip over the last 10 months was absorbed quickly, showing strong demand beneath the surface. Address how repeated top-calling narratives failed during this streak, reinforcing trend persistence. Explain why months 11 and 12 now become technically and psychologically important, especially when strong macro catalysts align with established trend momentum. Maintain a macro structural tone and focus on long cycle dynamics rather than short-term hype. Develop a comprehensive macro overview explaining how three independent catalysts: collapse of Iran nuclear talks, U.S. evacuation posture in Israel, and hotter than expected PPI inflation data occurred within hours of each other. Clarify why each event alone historically moves precious metals, but simultaneous occurrence creates compounded volatility and repricing pressure. Explain how financial markets price layered risk, not isolated headlines. Discuss correlation between geopolitical stress and safe haven flows, and between inflation shocks and currency debasement fears. Detail how algorithmic trading systems amplify volatility when macro signals cluster. Emphasize the concept of risk stacking. When geopolitical, economic, and monetary stress converge, asset repricing accelerates nonlinearly. Maintain analytical structure and avoid sensationalism. Write an in-depth geopolitical analysis explaining the breakdown of indirect U.S.-Iran negotiations. Discuss uranium enrichment concerns, sanctions leverage, diplomatic intermediaries, and the failed expectation of breakthrough during the third negotiation round. Explain why the removal of a diplomatic off-ramp increases binary risk scenario. Outline the two remaining strategic paths: continued nuclear development escalation or preemptive military intervention, potentially involving Israel with U.S. support. Analyze how markets react when diplomatic stability is replaced by strategic ambiguity. Discuss historical examples where failed diplomacy increased gold and silver demand. Maintain balanced tone, focusing on geopolitical risk premium expansion rather than fear-based framing. Write a detailed section analyzing the significance of U.S. State Department authorized departures from Israel, the ambassador's direct instruction encouraging immediate departure, and the phrase, "while commercial flights are available." Explain the layered signaling structure governments use in crisis escalation: travel advisory, authorized departure, ordered departure. Clarify why ambassador-level urgency suggests elevated intelligence-based threat perception. Discuss how airspace shutdown risk is typically associated with imminent conflict conditions. Connect bomb shelter openings with civil defense activation protocols. Analyze why markets treat evacuation language as a forward-looking instability indicator rather than reactionary measure. Link these signals logically to precious metal volatility. Develop a macroeconomic explanation of the Strait of Hormuz's strategic importance. noting that roughly 20% of global oil supply transits this choke point daily. Explain how energy markets price risk premiums even without actual supply interruption. Detail the transmission mechanism from oil price spikes to inflation, gasoline, shipping, manufacturing, utilities, and food distribution. Discuss how energy shocks historically precede inflation waves. Connect this potential oil shock to already elevated PPI data. Emphasize second-order and third-order economic effects, including consumer purchasing power, erosion, and business margin compression. Maintain structured economic logic. Write a comprehensive macro-monetary analysis of January PPI exceeding expectations. 2.9% headline. 3.6% core versus lower forecasts. Explain PPI as a leading indicator for consumer inflation. Quantify why a 0.6% core surprise is significant relative to the Federal Reserve's 2% inflation target. Discuss monetary policy constraints. Cutting rates risks currency weakness and further inflation. Raising rates risks recession, housing contraction, and credit stress. Detail rising delinquencies, debt saturation, frozen mortgage markets, and fragile small business balance sheets. Explain how policy paralysis undermines confidence in fiat stability and supports real asset demand. Write an extensive section analyzing China's elevated silver premiums on the Shanghai Futures Exchange relative to global prices. Explain what sustained price premiums indicate about local physical shortages or strategic stockpiling. Discuss China reclassifying silver as a strategic material and restricting export licenses. Explore implications of hoarding behavior from a major producer and consumer simultaneously. Analyze how supply chain nationalization trends affect global commodity pricing. Avoid alarmist tone. Focus on strategic resource management logic. Provide a structured explanation of declining registered silver inventories on COMEX. Clarify difference between paper futures contracts and physical delivery mechanisms. Discuss how vault drainage combined with rising open interest can elevate theoretical delivery stress. Explain mechanics of delivery failure without claiming inevitability. Detail how prolonged annual deficits, 67 million ounces, require stockpile drawdowns. Analyze systemic vulnerability when physical inventories shrink while paper leverage expands. Maintain factual tone. Write a detailed commodity supply analysis of Mexico, producing roughly 25% of global silver output to 202 million ounces annually. Discuss regional instability, cartel violence, logistics disruption, worker safety concerns, and mining company operational risk. Explain concentration risk when one country controls significant global supply share. Connect these risks to existing 6-7 million ounce annual global deficit. Detail how stockpiles compensate temporarily but cannot offset prolonged disruption. Maintain realistic geopolitical economic framing. Write a comparative macro financial analysis of total above-ground silver value to $150, $200 billion versus multi-trillion-dollar gold market. Explain how smaller market capitalization increases volatility when capital flows enter. Provide capital flow math examples showing how identical dollar inflows create larger percentage moves in silver. Clarify volatility as structural property rather than anomaly. Connect 1% gold move versus 6% silver move to liquidity depth differences. Write a technical market analysis explaining silver repeatedly testing $92 resistance before decisive breakout to $94 on high volume. Explain concept of resistance turning into support. Discuss role of volume confirmation in validating breakouts. Analyze gold to silver ratio 55-1, and historical compression during bull cycles to 30-1 or 20-1. Provide scenario math if gold remains elevated while ratio compresses. Avoid certainty language. Present as probabilistic framework. Develop a structured scenario framework. Conservative de-escalation with continued structural deficit. Base case, sustained geopolitical tension and inflation persistence. Escalation scenario involving military conflict. Oil spike above 150, potential delivery stress event. Explain macro implications and silver pricing behavior in each. Emphasize risk layering and probability assessment. Avoid hype. Present as strategic outlook modeling. Write a concluding macro psychological analysis discussing rising physical premiums over spot price, divergence between paper and physical markets, retail participation signals, dealer cues, and volatility expectations. Explain investor psychology during powerful bull markets, panic selling during pullbacks versus trend persistence. Emphasize 10 green monthly candles as structural signal. Reinforce alignment of geopolitical risk, inflation acceleration, supply deficit, and institutional accumulation. Conclude with data-driven bullish thesis grounded in observable macro trends rather than fear-based rhetoric. I'm not here to build a cult of followers. I'm here to build a community of thinkers. At Noble Metals, I provide the raw data, but I want you to bring the hard questions. We live in an era where debt is sold as wealth and clicks are sold as value. Don't just take my word for it. I encourage you to be a skeptic. Check my sources, challenge the mainstream narrative, and verify every claim I make. Because at the end of the day, a truth you've discovered for yourself is far more valuable than any hype or financial trend. Real gold is rare, but real truth is rarer. Let's find it together. This is Noble Metals. I'll see you in the next one. Stay skeptical, stay informed.